Good morning, Kinaway members, and welcome to another episode of Kinaway TV. I'd like to start off today's episode by acknowledging the traditional owners of the land in which we're all meeting and paying respects to elders past, present, and emerging. Today we have Tori back from TJS Accounting presenting episode 2 of a 3-part series. As a reminder, last Wednesday's episode, is still available to view on Kinaway's Facebook and YouTube. The episode revolved around discussing financial principles that relate to your business, whether it be applying good practice when lodging business activity statements to understanding what tax concessions may be available for your business. So if you failed to catch it, feel free to jump on the Kinaway Socials and have a look. For today's webinar, Tori will be discussing all things on understanding a balance sheet and its various elements. Some topics discussed will be the difference from other financial statements, such as a profit and loss statement, a cash flow statement, and she'll explain their intrinsic relationships. She'll also explain the assets, liabilities, and equity elements on the balance sheet. I'd also like to take this moment to remind those in attendance of the Kinaway business support packages currently on offer. These specialist support packages help provide access to a range of bookkeeping and accounting services, preparation and submission of tax returns and BAS statements, all-in access to Xero and MyOb, tax and payroll obligations, superannuation and work cover obligations to staff, all at a maximum of $1,500 exclusive of GST per business. If you feel this may be of use to you and your business, please fill out an expression of interest available on the Kinaway website. We hope you all find today's webinar useful. If you have any questions, please post them to either Facebook or YouTube, as Tori will be addressing them after the presentation. I'd like to welcome Tori for today's webinar, and as always, don't forget to leave a comment, subscribe, and turn on the notifications to receive Kinaway updates.
Thanks, James. Great. Hello, and thank you for having me back again. Yes, today is our second part on financial literacy. Again, I'll just, reintroduce myself. My name's Tori. I'm a public accountant. I'm a registered tax agent, member of the Institute of Public Accountants. I'm also the Deputy President of the Divisional Advisory Committee for the Institute of Public Accountants. I'm an associate of the Tax Institute. I'm a registered ASIC agent. I too am a business owner and very privileged to have been the winner of the 2019 IPA Practice of the Year Award based on our client feedback. So that's a little bit about me and my role in the business. Of course, my why. And I always like to start with, I thought I'd start with a quote. The road to success is always under construction, and that is certainly the case in business. Today we are covering key financial statements and your financial documents. So covering off on the statement of comprehensive income, often known as profit and loss statement, statement of financial position, often known as the balance sheet, the changes in equity, and the statement of cash flows. We'll also be covering other information, the supporting documents that you will find in that. And for those of you in business, and certainly those of you with company structures, trustee structures and the like, no doubt you are receiving full financial statements, and understanding them can obviously be a little bit complex at times. So just to cover off on the importance of financial management. So obviously financial management is about dealing with financial information to ensure the most effective use of the financial resources of the business. Reading financial statements can be complex, and understanding the language of finance is often daunting. Accounting terms can be confusing, and some of the items commonly shown in financial statements may be somewhat unfamiliar. So today I hope to try and break that down a little bit for you. Obviously, business owners are expected to act with integrity and all times behave ethically when dealing with the business finances. So having sound financial management and reporting must be supported by your processes that ensure that the information in the financial statements provide a true and fair view of your entities and your business financial performance and position. So your business annual financial report includes a number of key financial statements and supporting documents. Statement of comprehensive income, the profit and loss, financial position, as I say, statement of changes in equity, cash flows. So let's have a look at the comprehensive income, so oftenly referred to as the profit and loss. So the statement of comprehensive income, profit and loss statement, it reports the organisation's financial performance over an identified reporting period. Now, obviously, the reporting period is most commonly 1st of July to the 30th of June. Now, the profit and loss covers the income in the financial year, so the revenue, and expenses incurred during that period, which is subtracted from the revenue earned during the same period, and that determines the profit or loss generated. The statement also provides details of other comprehensive income. So sometimes it includes other gains or interest income, gains and losses on investments. Sometimes you'll see revaluation of land and buildings and other items, which are sometimes outside the business activities. The statement of financial position, also known as the balance sheet, shows what the business controls. So we're looking at the assets and the liabilities at the end of the reporting period. So when we're reading the balance sheet, it's actually taking a snapshot of the business, usually at 30th of June, which is when the end of the financial year reports, or if you require financial statements for a purpose at the period of time as specified. Assets describe the items of value that the organisation or your business controls or has a right to control. Usually it includes cash, receivables, land and buildings, equipment, vehicles and computers. It can also include tangibles and intangibles, which are not physical in nature, but we might find things such as goodwill within the assets. And intellectual property or software. Assets can be further categorised under subheadings, and we often see them listed as current and non-current assets. So current assets are those assets that are expected to be converted into cash or consumed within the next 12 months. So when we're looking at the different items, we'll usually say, well, current assets will usually determine the next 12-month period. It will often include cash, so trade debtors or your accounts receivable, or prepayments, sorry. For non-current assets on your balance sheet, that'll usually mean that it's items that can be utilised beyond the 12 months. So quite often you will find in here assets such as land and buildings. You might find your motor vehicles, plant and equipment, and often you will find what we call the small business entity general pool, which consists of a range of assets. And the reason that, again, they're in the non-current assets is because the anticipated life use is actually longer than the 12-month period. Now, so too with liabilities. So liabilities in the balance sheet are amounts that are owned by the organisation or your business, to external parties. So you'll actually find liabilities, so loans and so forth. So items that you may own an asset, but it's financed with the liability or the bank loan. So the financial obligations of the business, either to another organisation or to a banking institution. Examples include, as I say, accounts payable, financiers, so loans. You might find hire purchase for equipment finance, bank loans. You'll also find in here accruals such as staff entitlements, annual leave accruals and long service leave accruals. So when we're looking at your liabilities, again, they can further be classified under the subheadings of current and non-current. And just like the current and non-current assets, we look at current liabilities being amounts that are expected to be paid within the 12 months, which are listed as current liabilities. Usually you will see the accounts payable. Tax liabilities are often found under your current liabilities. And so too for non-current liabilities, amounts which are likely to extend beyond 12 months. So that could be potentially business loans, hire equipment agreements that extend beyond the 12-month period. So equity is essentially your business net worth. So when we're looking at equity, essentially your equity is your assets, less your liabilities is your business net worth. And I guess to give you a bit of an example of that, if your business purchased a building for example, $1 million, finance that by way of a mortgage of say $800,000, usually that would indicate that the equity that you have in the building is $200,000. So while the business would effectively own 20% of that building, it would be shown as a statement of financial position as a non-current asset at $1 million and a non-current liability, so it's payable over a period of years, at $800,000. And the difference of that is actually formed as a part of the total equity of the business. So I guess we'll have another quote: the secret to your future is hidden in your daily routine. So essentially your daily routine is your business ins and outs, and you are dealing with the business transactions. You may not be aware of it, but you're actually dealing with your day-to-day cash handling, transactions, and the using of your assets and so forth. So you're dealing with all items within your profit and loss, your balance sheet, etc. And your daily routine, well, as I say, can have big control over your financial position. So a statement of cash flow, unlike a profit and loss, it's actually the movement of the inflow and the outflow of cash over the reporting period. It shows the flow of funds moving in and out of your business, the difference between the receipts that you receive and payments that you make is the net movement in cash for the period. So in some ways, a cash flow statement looks similar to the profit and loss statement. However, there are obviously major differences and mostly timing differences, which are fundamental financial performance indicators. And it's often reported separate to the accrual accounting method. And look, cash flow, obviously, cash inflow and outflow occur as a result of three major types of activities. So what you'll find in business is that with those activities, you'll have your main operating activities. So that's obviously when people are paying you for either your services or if you're selling products. So that would be the cash inflows into the organisation. And so too, under operating activities where you are, the payments that you're making are for the stock or the product, or paying staff, so wages, and overhead. So they're all sort of, the operating activities that go along with that. Another cash inflow and outflow is investing activities, and not necessarily through banking, although it can be. So interest that can be earned is a cash inflow through investing, but also the cash outflow through bank loans and so forth, hire purchase agreements. So when the business acquires non-current assets, it has cash flow outgoing as well, as far as finance or along with that. Financing activities, of course, comes into the bank loans as well. So there's a number of different operating and cash flow activities that will affect and are often itemised within your cash flow statements. So obviously, when you receive financial statements from your accountant, you'll find that you have incorporated into there what those are often known as notes to the financial statements. Now, essentially, the key financial statements contain the vital information. So, information on accounting treatments, so whether we're looking at cash or accrual, and it's often an explanation of how the amounts have been determined within the full reports. So they provide not only a snapshot of the organisation's financial performance and position, but if you really want to, I guess, explore it further, it gives you an analysis of the results so that you can take comparisons with other organisations or within your own organisation and looking beyond, I guess, the raw numbers. So the notes to the financial statements provide details and explanations on that. In some cases, accounting standards may allow a choice regarding the accounting treatment of how to handle your profit and loss and balance sheet. So where a choice exists for the accounting treatment, the method chosen by the business becomes an accounting policy, and you'll find it within the notes to the financial statements. So accounting policies must be disclosed in the notes to the financial statements, and are usually shown as Note 1, summary of significant accounting policies. So I guess some of the things that are covered within there might be income tax. So it will cover how income tax has been applied and shown within the balance sheet and the profit and loss. It will list loans and receivables. So sometimes it might recognise them at initial cost, or we may have the availability at measured cost, or taking into account any impairments on those. So it will list information such as goodwill, employee benefits. It may provide details as to how you have actually come to those figures, including cash and equivalents, revenue and income. It may cover also leases and fixed assets and also depreciation. So it will actually give you a breakdown and a further understanding of how those expenses or amounts have been itemised within the financial statements. So the analysis of the financial statements, what does it really mean to us? Basically and overall, it gives you a real insight into your business performance. It gives you an insight into the financial position. It's about understanding the business's strengths and its weaknesses. It gives you an opportunity to identify risk areas and predict future performance and the viability and sustainability of the business. So obviously you want to be sure that your business is well managed and delivering its objectives in a financially effective and efficient manner. So by actually examining the organisation's financial statements, you can gain an insight into the current financial performance of it and the position, understand all of the strengths and weaknesses and so forth. So a look at each of the financial statements contained, so looking at the comprehensive income, the statement of financial position, statement of cash flow, gives you a really great understanding of your business's financial health. So the statement of comprehensive income can reveal whether the organisation is making a profit or a loss. Obviously, the statement of financial position shows whether the organisation and your business has positive or negative equity. The statement of cash flows indicates whether the cash that you have on hand and available is increasing or decreasing. So obviously they're fundamental observations and provide further analysis of the numbers required in order to gain an understanding as to whether the business's financial performance is in a good position and operating satisfactorily. For example, a profit may have been generated, but was it actually enough to pay down its debts? How much profit is enough? Can a positive cash position, Is it sufficient, or will it be enough to sustain moving forward? So there's lots of different reasons why we'll be looking at the analysis of the financial statements. I guess when you receive your business statements, and if you're having a look and you can run through some of the figures within that, some of the things that we should be looking for is comparative, comparing this year to last year. If we're looking at revenue, did revenue increase, did it decrease, why did that occur? Having a look at the expenses and the outgoings. Have I had a big increase in my materials? Does that mean that there's been a change perhaps with a provider? Should we be looking to outsource or obtain a new provider? Looking at all the overheads, where can we cut down those overheads, etc. What has been an increase, decrease? Some of those factors obviously will be relatable to different business environments, but sometimes it could be a case and provide an opportunity to actually review those statements and gain a really good insight into making changes in your business. I guess managing your business's finances and revenues is, in itself almost feels like a full-time job. But I guess if you're a small business owner and you can have a bit of an understanding of the figures as you're looking at them, there are probably some basic formulas that through accounting that you might need to know or should be aware of. They're generally regarded as universal for any business, but they give you an overview and provide you some understanding to the viability and the health of your business. So if we're looking at this, the accounting equation, again, if we look at assets, well, we can look at it from the perspective of assets equals the liability and plus the owner's equity, or again, assets minus the liability is the owner's equity. What does it mean for you? Well, assets are, of all things, what your business and your company owns. It includes the property, cash, stock and equipment that will provide you with future benefit. Your liabilities are obligations that you pay, including things like the lease payments and the merchant account fees, your debt services and so forth. Whereas your equity is a portion of the business that actually belongs to you, the owner. If we're looking at the net income, the equation, obviously, revenue less expenses equals your net income. What does it really mean for you? Revenues are the sales or other positive cash inflow that comes into your business. The expenses are the costs that are associated with making those sales. And so too, by subtracting your revenue from your expenses, you can calculate your net income. So that's the money that you've earned at the end of the day. It's possible that this number will be negative if your business is not running at its best, but the goal is obviously for your business's net income to be positive and meaning that your business is viable. Break-even point, what does that mean for you? Fixed costs are recurring, predictable costs that you must pay in order to conduct business. And they usually include insurance premiums, rent, employee salaries. So that we know that regardless of the income that's coming through, they're not going to be the same. We're still going to have those fixed costs. The sales price is a retail price that you will be selling your products or your services for. And the variable cost per unit is the amount it costs you to actually make that product. So if you divide your fixed costs by the sale price of your product, and minus the amount that it costs you to make your product, you'll have a break-even point, which gives you an indication as to how much you need to sell in order to recover your costs or effectively break even. Looking at the cash ratio, the equation is cash divided by current liabilities. What does that mean for you? It gives you an idea of how much cash you currently have on hand. So cash effectively is simply the amount of cash that you have at your disposal. So either in your bank account or coming into your hands within the short period. It can include actual cash and cash equivalents. So if we're looking at investments and securities and so forth. But your current liabilities, again, are the current debts that the business has incurred. So the ratio itself, it demonstrates how well your business can pay its current liabilities. So in this case, we're looking at the higher the number, the healthier of the business. So for your profit margin, the equation profit margin basically is your net income divided by sales. Net income, what does this mean for you? Well, net income is the total amount of your money your business has made after the expenses have been removed. The sales are the total amount of sales that you generated for the period. So when you divide your net income by your sales, you'll get your business profit margin. A high profit margin indicates a really healthy business, and a low profit margin can reveal a not so healthy business. But it doesn't mean to say that your business doesn't handle its expenses well. It really is dependent on the type of business that you have. And if you have a high sales revenue but still have a low profit margin, it may just mean that you need a higher turnover, or it may take longer for those figures to become more profitable. Looking at our debt to equity ratio, so that's where your total liabilities are divided by your total equity. What does that really mean for you? Well, again, the total liabilities, which is all of the costs that you must pay to your outside parties and your debtors and so forth, such as loans and interest payments. And equity is how much of the business actually belongs to you, the owners, or the employees of the company. In other words, it's the amount of money that the business has invested in its own company. So a high debt to equity ratio illustrates a high proportion of the business financing comes from outside services, such as banks. So if you're obviously attempting to secure finance or looking for investors, a high debt to equity ratio might make it more difficult for lending, but it basically gives an overview of, as I say, how much is owned by you, the business owner. So looking at the cost of goods sold, what does it mean? Well, the cost of the materials or your stock is the amount of money that your business has to spend to actually secure the products or the materials in order for you to make a sale or manufacture your product. And the cost of the outputs, so that's the cost of making those materials, or the cost of making and manufacturing. So obviously by subtracting the costs of those outputs against those materials, you'll get to know your cost of goods sold. Now, this actually tells you if the costs that you're paying to make your product are in line with the revenue that you earn when you're selling it. Having a look at the retained earnings equation. So looking at this, the equation itself is, well, retained earnings equals the beginning retained earnings from a prior year plus the income of your business or the loss, and then any cash dividends that are paid. So when we're looking at retained earnings, they represent the sum of all of the net income of since the inception or the beginning of your business, essentially. The beginning retained earnings is the balance of that from that prior period. So the net income of the business is for that financial year. So it represents the balance after subtracting expenses from its revenue in that accounting period. And it can also come into a loss. But cash dividends are where cash payouts have been paid to the shareholders or the investors. So that may be a case if the company has had retained profits and it's chosen to pay out a dividend, well, obviously it's reduced the equity within there. So importantly, it's important to have a thorough accounting system, something that you can actually allow you to process and assess the financial health and be able to obtain all of the information so that we can obtain those reports. Obviously, there's so many formulas that can be used, but some of these that we've just shown you are some of the most basic and easy to, I guess, run with your accountant so that you can get a greater understanding of the business's financial health. So I guess many business owners still find it really challenging to get the right side of the equation. And in business, it is a case of working through that and using the figures and those numbers to obviously obtain the best possible outcome. So obviously, it may seem very daunting to look at financial statements, but to get a better overview of your business, obviously the secret of getting ahead is just that, it's just getting started. So when we're looking at financial statements and we're wondering, why do I receive these documents? Well, who's really going to be looking at the financial statements themselves? Well, I guess it's important to be able to show banks, and lenders will be wanting to see your financial statements. So having a really clear overview of your business is important. So too, if you are looking for investors to come on board with your business, they will be wanting to see, they'll be running some of those equations to see how much profit the business is generating, how much equity it has, what are the assets of the business. So investors are really important. The Australian Taxation Office, so the ATO, might be interested in your profit and loss and balance sheet. And of course, the most importantly, who's looking? Well, you should be looking at your financial statements. I guess when we're looking at why are banks looking at financial statements and what does it really mean, if you're looking at borrowing, I guess understanding the borrowing capacity. So things that they're looking for, lenders are looking for what businesses declare as their income in both their financial statements and their tax returns, so that they can determine the income reported in order to determine the borrowing capacity. So they'll be bankers and lending institutions will be looking at your profit and loss. They'll be looking at the profitability of the business and any payments made to obviously the business owners by way of wages and benefits and non-cash expenses that can be added back. So we're looking at things like depreciation, interest on loans being refinanced and higher purchase expenses and so forth, because that can potentially be added back into the profitability. What the lenders don't want to obviously see is big wages coming out of the business, but the business itself is in a loss. So other things that can be included that are a benefit to you, paying additional superannuation over the 9.5% and so forth. Borrowers will also be looking at the balance sheet. They're looking to see what commitments the business actually already has. So that will determine the viability of any potential further loans or potentially refinancing. So things that they're looking for will obviously be vehicle loans, intercompany lending amounts, a complex issue, but Division 7A amounts, so amounts that were taken by shareholders or their associates out of the business and are owed back into the business. They're looking for ongoing lease commitments. So borrowers are looking for all of those commitments, and you will find that information contained within the balance sheet. So I guess, we're looking at it. Two key components of the financial literacy is understanding your own business and your own business financials, but also conduct as far as repayments are concerned. So the lenders will be looking to see whether or not the loan repayments have been made, and they can look at that through those comparative financial statements, etc. And I guess it's also to be mindful that credit files now have, they can see 2 years of repayment history. Why would the ATO be looking at your business performance? So why would the ATO be interested in your profit and loss and balance sheet? Well, I guess if we just break this down just very quickly, if we're looking at your ATO accounts when you're in business, you have potentially three accounts with the ATO. Normally you'll just see 2, but income tax account. So that is where you will see your income tax that is being paid for your business or either company, trust, or you as an individual. So the taxation that's paid. The integrated client account, that is where you will see a running balance of your business activity statement. So that incorporates GST, PAYG withholding from employee wages, and PAYG instalments. And there could be a super guarantee account. So if you haven't paid your employee's superannuation on time, you have an obligation to lodge a super guaranteed charge, and then there will be a running balance, so paying down any outstanding superannuation. Why do the ATO interested in your financial statements though? They're wanting to see, usually if you are organising a payment arrangement or you are negotiating and dealing with the ATO, they too are interested in the viability of the business. They want to see, is the business solvent? Can it pay its bills if and when they fall due? Can you afford to pay the taxes, or can you actually afford to pay down a payment arrangement? And so forth. So you may be required to provide your profit and loss or balance sheet to the ATO. The ATO also utilise quite a lot of information, and something that you can look at, so is the small business benchmarks. So if we're looking at who's looking at financial statements and we say you should be, then you too can use those same things that the ATO have available to do your business. So what I have here is the small business benchmarks, and if you're looking at the screen there, you'll see the link in order to be able to view that. So essentially, the ATO provide a guide to help you compare your business performance against other businesses in a similar industry. They're looking at the cost of sales to turnover, total expenses to turnover, rent to turnover, labour to turnover, and motor vehicle expense turnover. So the easiest and quickest way to see how your business compares to competitors could be a case of using the ATO business benchmarking check tool. So you can enter your details into the tool and it will calculate and compare your data compared to that of other businesses, comparable to your competitors, I guess, and other businesses in your industry. So performance benchmarks are financial ranges for your industry that help you work out how you compare to others, and if you need to make any changes or improvements. And there are two types of performance benchmark ranges that the ATO utilise. So that's obviously by way of income tax and the activity statement, so what you're lodging to the ATO. When they're looking at those benchmark ranges, as I say, they're looking at the cost of sales to the turnover, expenses to turnover, rent to turnover, labour to turnover, and motor vehicle expenses. They're also looking at investments, so non-capital purchases, and GST-free sales to total sales. So if your business is inside the business benchmark range for your industry, fantastic, but it can identify where adjustments need to be made to either costs and expenses, or you need to consider profit margins to improve your business performance. So you can consider if your record keeping or business operations needs any improvements, and again, that will aid in increasing your profitability in the business. Why should you understand your financials? Apart from benchmarking, apart from comparing, apart from looking at loans and financing, when you have an understanding of your business financial statements, so understanding of the profit that you are making, understanding of some of those equations that we were looking at, your net profit, your equity ratio, and so forth, you will have an understanding of where your business is heading. You more than likely have a business plan and wanting to move ahead with the business, or have goals that you're wanting to achieve. But asking questions of your professional advisors, so asking your accountant, what does that mean for me? How do I make the changes? By picking these out and reviewing those financial statements, you get a really in-depth overview of your business, because remember, this is your business. It's about you improving the growth. It's about you growing that business. It's all about your future. So ask a lot of questions. Don't be afraid to ask your accountant, what does this really mean for me? Where can I improve? Have a look at the comparative figures from one year to another. What do the changes mean for me? And can you explain that? Obviously, again, a goal without a plan is just a wish. So have a plan, have some questions linked and ready to ask your accountant. Just to touch base on some of the things that we've had and we touched on in the previous presentation, but a business plan. Again, a business plan, it's a detailed roadmap that explains what your business goals are and how you're going to achieve them. You can utilise your financial statements to assist you with your business plan. You can utilise those financial statements to see, what do I need to change? What are the areas that I need to make changes in to and build that into your business plan to increase the business growth. Understanding the cash flow. So by reviewing those financial statements, you're going to see the money coming in and out. You'll be able to track your money. If you ever wondered why I feel like I'm working really hard, but I seem to be making sales, but I don't seem to have any money in the bank account. Having a look at those cash flow statements and looking to see and identify, is there an outflow of funds that we can cut back on? Do I really need that? Is there something else that I need to increase to generate more income? So looking at that cash flow, understanding the business budget and understanding your own personal budget, how much money you need to be taking home. Again, really important. Having good bookkeeping. So having a good bookkeeping process, having something in a systemised manner that you can refer to, it's going to assist you to be able to see all of these financial statements. That it's going to be able to provide you with some way of you providing or running a report for a profit and loss. It's going to make it easier to see what your tax obligations are so that you actually know in advance. It doesn't become a shock when a business activity statement comes in and it's really high. Why is it? So by having a bookkeeping system and keeping everything itemised and tracking your records is really important. Again, different things to consider. So having a look through the financial statements and looking long-term, borrowing capacity. Am I looking at investing in the future? Am I putting aside for my superannuation? What does it mean for my employees? Where am I moving for the future? What does the business goals mean? Do I have an exit strategy? They're all things to take into consideration and things that your financial statements can assist you with in your planning process. And of course, ask for advice. There's a range of professionals who can give you excellent support, who can answer the questions that you might have. So speak to your accountant. If you're not sure of bookkeeping, engage a bookkeeper, potentially a financial planner. Utilise where the wealth will go in the future. But there's a lot of people there to provide advice. And of course, ask the business chamber. There is, Kinaway has a range of support options available for you. So surround yourself with people who shine. Take a moment. I always like to say, take a moment for yourself in business. There is a lot to take on board. So enjoy the moment for what it really is. Of course, for many of us, we are amidst COVID-19. We're dealing with a lot of external pressures. We have just moved into another announcement of JobKeeper Point 2, but there are a range of options available for you. So JobKeeper, Job Seeker, Cash Flow Boost, early release of superannuation, paying tax by instalments and varying those, a range of state government grants, and of course the IBA Indigenous Relief Package, accelerated depreciation and support for apprentices and trainees. If you need assistance during COVID-19, please do not hesitate to reach out and ask yourself, are you okay? Take a moment to ask yourself, are you okay? Business can be difficult at times, but there is a support network there for you. Here's one for you. Don't wait for an opportunity. Create it. And if that's a case of reaching out and asking questions and getting a better insight into your business financials, then I say go with that. Of course, my disclaimer, general advice, warning and disclaimer, I'm an accountant. And my contact details are here if you'd like to reach out, by all means. Thank you, James.
Thanks, Tori. That was a great presentation. Plenty of useful information there. I'd just like to open it up to some questions now. I think we've had a few come in. So what we'll do is they should pop up on the screen. I can read them out, and then, hopefully you can address them for those viewing. Okay. So the first one we have is from Jeremy, and he asks, what financial statements will my accountant give me normally when I have my tax done?
Good question, Jeremy. It really is a case of having a look at the business entity itself. If you are a sole trader, you may not receive financial statements like what we've just looked at. You may, in fact, have to ask for those types of financial statements. Companies and trusts are entities that we would normally see, in partnerships we usually see the detailed financial statements, and usually that's because there is a requirement by ASIC and the Constitution and trust deeds. But if you're a sole trader, you may in fact need to ask for that information.
Sure. I think we have a few more. This one is from Erica, and she asks, I had my tax done last year and had a profit I had to pay tax on, but I hadn't received the money yet. Why did I have to pay tax on money I hadn't yet received? Yeah,
look, that comes down to accrual versus cash accounting, and it is determined by the type of business that you operate. So generally speaking, if you are a service, so if you are skills and labour, and essentially what we call personal services income, where you predominantly use your skills and expertise, you will find that we account for taxation and profit and within the business based on a cash basis. But where you are buying tools and equipment, or you have materials or stock, what you'll find is you actually fall into an accrual basis. So if you have raised invoices or sales but haven't yet received the funds for it, it does come into account, and it comes into the profit in the time that the actual invoice is raised. So you may have been paying tax on that. You should also look at and make sure that if you haven't received those funds in the next financial year, bring that to the accountant's attention.
Sure. Cool. I think for another one, here we go. And this one is from Toby. And he asks, I've been told I should use a bookkeeping software. One friend has told me I should use Xero, and another has told me to use MYOB. Which one should I use? What's the difference? I don't know anything about bookkeeping.
Yeah, look, that's a really common one. And what I would encourage you, bookkeeping programs are amazing. They've really changed from over the years, and most bookkeeping programs you will find can be accessed via the cloud anywhere where you have an internet accessibility. So when we're looking at Mile, so there's Mile Essentials, and you can also look at Xero. I think it's going to come down to user preference, something that you're more comfortable using. You can have a look at a demo at these. Effectively, they're both really great programs, and they are base level programs for people to easily use. I think it's really up to you as to which one you would like to use. But again, if you'd like to reach out, we can have a look at the needs, and we can most definitely give you some pointers there.
Wonderful, wonderful. Next one is from Paul, and he asks, is there a recommended amount of cash a small business should have at its disposal to make sure the business meets its obligations?
Yeah, look, really great question, Paul. I don't know that it comes to a percentage or it comes to a specific amount, but by looking at having a look at your financial statements, you can definitely see what the next 12 months cash flow has in hand and has in store for you, I guess. But most definitely it's important to be able to manage cash flow. But what you should be able to do is also take that information and potentially put that into a budget. So working off a budget for a period of time in a month-to-month basis will give you an indicator as to how much money you actually need for capital, but also coming into the business.
Wonderful. And I believe we have one more, the final question that we've had come through, and it's from Alicia. And she asks, my accountant prepares my tax and financials but doesn't explain them. I just know what profit I made and tax I need to pay. What are some good questions to ask him about my business?
Yeah, really great question. Potentially having a look in or even asking to sit down and just go through the financial statements is a really great start. So if you can run down through the line items, so if you're looking at your profit and loss and you're running through the different items, there'll be things in there that you might not be aware of. For example, depreciation is always one that comes across. It's a non-cash expense, and it's an accounting formula that we come up with to offset your business profit. But by actually asking those questions and saying, look, can I just have a little bit of your time to run through that profit and loss, you'll be able to identify what's been included. And of course, if anything has been missed, but it'll give you a better understanding of that business performance. And so too, by looking at the balance sheet, you'll notice that some things are not necessarily they're not in the profit and loss, but there's been a cash outflow, but in return it's sitting in the balance sheet. Why is that? So again, a little bit of time, just ask them, so I just would like to go through the line items with you.
Yeah, that's great. Well, Alicia, I hope that answers your questions, and to everyone else that's submitting questions. I'm sure Tori answered them adequately, and you got the information you needed as well. So I think that may be it for today's questions and for today's presentation. So thank you again, Tori, for today's webinar, and thank you to everybody who tuned in. For all you Kinaway mob out there, don't forget to tune in this coming Friday at 11 a.m. where we have Adam and Carmel from Empower to Digital back presenting their webinar about checking the pulse of your e-commerce store. In this webinar, they will introduce merchants who already have an e-commerce presence, methods to assess their store and their site's performance through providing a checklist and some hands-on tips ensuring efficient online performance. Tori will then be back same time next Wednesday with a presentation about individual finances, covering topics such as early access to super, some of the pros and cons, and things about budgeting and just some subjects of that sort of nature. Until then, don't forget to check out the Kinaway Business Tax Support Package. Subscribe to the Kinaway channels, turn on the notifications, and most importantly, have a good day.